Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital.
I'm Chad Sheeler, founder of Focus Capital.
Chad, today we're tackling this distinction that trips up a lot of investors. I mean, even just saying the word distinction tripped me up. The return of capital versus the return on capital. So these two phrases sound almost identical, but they mean very different things, and confusing them can lead investors to misread how a deal is performing. So let's talk about the core distinction. Let's define both clearly. What's the difference between the return of capital and the return on capital?
I think first and foremost, disclaimer, we're not CPAs or tax right? So that's off the table here.
Very common disclaimer on this podcast.
But yeah, Jared, so like return of capital is your skull distributions, right? That's coming back to you, and that's basically returning the personal capital that you invested, paying that down, right? It's reducing your personal balance. And that typically is a non-taxable event. Return on capital is you're getting a return on your money. So let's say you have a $200,000 in a deal, you get 5% return. Let's call it, $10,000 in a year's time. That would be a taxable event, but your personal balance still remains intact. It's a return on your capital that you put in.
Correct. I think the one thing that I would give a caveat in is you said the word distributions when you were talking about the return of capital. Just because something is distributed doesn't make it a distribution. Distributions are usually referring to a yield or gain generated above and beyond what was originally invested. And so that would be a return on capital and not return of capital.
Correct.
So if you invest $100K and you receive 8K in distributions from the operating income, that's a return on capital. A return of capital, like you said, is simply just getting your own money back. It's not profit, it's the repayment of your original principal. And if a deal is struggling and distributions are being paid from reserves or other non-operating sources, investors may be receiving their own money back while believing they're earning a return. So I think it's kind of important to frame those two, define those two, and make sure that you know that one is rewarding you for just deploying capital, and the other is just simply getting your capital back.
Yeah, I think touch on that a lot more is important for investors to look at too, is the return they're getting back or the distribution they're getting back, is that coming from the property operations, the performance, or is it coming back to them through a distribution reserve that was raised for the property?
Yeah. So that touches on a very important point. Why does this matter so much in practice? This distinction matters so much in practice. Like, why should investors care about the distinction, and what's the real world consequence of not understanding it?
Well, for example, if you're getting all this money back from a sponsor group and it's return of capital, that could be really kind of lowering your returns that you should be getting otherwise.
I think also it has to do with performance. So whenever I talk to investors, and if an investor confuses the two, they can significantly overestimate how well a deal is performing. So a distribution check of any type can feel the same whether it comes from a rental income or reserves. So at the end of the day, it's the same number on the check, but the implications are entirely different. Like you said, the return of capital doesn't compound and it doesn't reflect operational health. In some cases, it can be a signal that cash flow is actually insufficient to support the distribution level being paid. And if an investor reinvests or benchmarks a deal against that distribution without understanding its source, their analysis is built on a flawed foundation. So even though they're receiving, X amount of dollars in their distribution, doesn't always mean the deal is performing healthily, because if they don't understand the source and they don't understand that simple distinction between return on capital and return of capital, they're going to be thinking they're going to be in for a rude awakening at the end of the deal.
Big surprise.
So how does this show up in real estate syndication? So in the context of passive investing and syndication specifically, where does this distinction become the most relevant? I think the first one, it would be a refinance event, and the second one would be the preferred return mechanics. You kind of got into the preferred return mechanics. Would you like to start with that second step?
Yeah, I'd say that preferred return, going back to the investors, that would be return on your capital, right? And then the refi event, that's going to be hopefully return on your capital, catch preferred return up, and then return of capital, the amount to be determined. And then obviously a sale will be return on capital. Return of capital as well.
Yeah. So just to re-clarify some of the few common scenarios. First, the refi, like you said, this is when a sponsor conducts a cash out refinance or a cash out refi for short-term lingo. Investors may receive a large check that may be called or labeled a distribution, but that's a return of capital, not profit. The property hasn't been sold and no gain has been realized. So the equity that's been unlocked and returned is really the original investment, and that's effectively been reduced.
Yep.
The second scenario that we just talked about is the preferred return mechanics. So some deals pay a preferred return using reserves or deferred fees in the early months before the property stabilizes. And so investors receiving those distributions should understand that whether that cash is coming from operations or from a reserve account. We typically do not give distributions from reserve accounts. We only give returns from operational cash flow. And we talked about in an earlier episode why there might be 1 or 2 quarters after acquisition where we don't pay out distributions, because even if a property is cash flowing and the deal is healthy, there is some operational reserves that we need to hold there just to maintain the property. The last thing that I could think of is obviously the exit event, like a sale. The full return picture only becomes clear at the exit. So when investors see the total distributions received, their return on the original principal, and the profit on top, most investor decks, us included, will kind of show that sample investment return. And so if someone is understanding where their distributions, air quotes for the people that are just listening, are coming from, they're going to be in for a rude awakening at the end when they're seeing like, oh, I was still expecting this other windfall of my return of capital.
And principal first, plus your,
Correct. And if they were getting their principal back over the time period and their ownership is going down or the equity is going down or however the deal is structured, like at that point, it's too late. So it's really important for LPs to understand first off, and then secondly, for anyone in IR or any type of investor facing role to be able to effectively communicate that.
I think one sign to that would be, or one due diligence part that you could do would be if the sponsor has accurately prepared their deck that clearly matches how this is structured and how distributions fall, then that is a sample cash flow scenario that shows what amount of the principal payback is going to happen in that latter year of the sale, whatever. That should show you that, okay, this is going to be return on capital throughout the years, return of capital at the very, very end. That should show you which way it's set up.
Yeah, it goes all back to the level of transparency. I mean, obviously PPMs can be, 130 plus pages, and there's a lot of legalese in there that protects both the operator and the LPs. And obviously review that with your legal professionals, review that with your tax people. Like the onus is on the investor when they sign that.
Yep.
But if they have any questions, then the onus is on, the GP at that point to be able to provide answers of those things. A lot of PPMs are structured in very similar ways, and it's just, some of the deal mechanics that change. Another point that I wanted to make is how giving a high line of how investors should read a distribution statement or a K1 with this lens of return of capital versus return on capital. So in my experience at the distribution level, investors should be asking sponsors directly, is this distribution coming from operational cash flow or from another source? And transparent sponsors should be able to communicate this clearly. It's one or the other. And then on a K1, the return of capital typically appears as a reduction in the investor's adjusted basis rather than ordinary income. And so that tax treatment alone is a signal of what type of distribution was received. Now, the only caveat that I'd have there is obviously you only receive your K1 once a year. So by that time, that last minute realization would be too late.
Yeah, in the investor portal, for example, with the one we use, like it'll show on there, okay, there's a return of capital, return on capital. So we'd be able to see on there.
Yeah, but not everybody has that portal. And so our investors, we know that we actively communicate, and the best operators proactively communicate the source of every distribution, not just the amount, and not just about distributions, the healthiness of the property, the stabilization process of the property. Every single property, even our core plus deals, which don't need a ton of work, quote unquote, the work on when it comes to like the value add propositions, there's still a point of stabilization when you're taking over a property. Now, our most recent acquisition, Gateway Crossing, like that stabilization period, because we had a similar property, stabilized relatively quickly, and we were able to pay out the first quarter after acquisition. We were able to pay out distributions for that. But over communicating, proactively communicating, and being transparent in your communication often and clearly with your investors will also help them know kind of where those things are coming from, even way before the K1s are even distributed. Last question here, is return of capital always a red flag? I'll give you some context. So we don't want to leave investors with the impression that return of capital is inherently bad, because it's not. When is it intentional and appropriate for return of capital?
Well, return of capital should happen at a refi event or a sale event, obviously, right? That's great. But also there are some scenarios to where I can see a return of capital instead of return on capital can be more advantageous for an investor. For example, it's not a taxable event. You're getting your capital back and you're reducing your risk by getting your capital back. So now whether the distribution comes back in the form of return on or of capital, it's the same amount of money, right? But I can see somewhere where some investors may want to, what could see a benefit to return of capital. But I think widely spread, most times these are all set up as a return on capital initially.
Yeah. And like going back to what you said, a refi is a perfect example of a well structured and intentional return of capital, because returning that capital to the investors while the asset continues to appreciate and produce income is a sophisticated tax efficient strategy. And it's not a warning sign. That's not a red flag. In some structures, returning the capital early actually improves the investor's overall yield by allowing them to redeploy that capital sooner. So whether it's in another deal with the same syndicator or elsewhere, because they are able to redeploy that capital while this asset is still appreciating. So I think that, to summarize that point, it's not always a red flag. The return of capital itself is not inherently bad. It's when it's disguised as a return on capital, or when investors don't understand the difference. Yeah. Also, we always have the disclaimer that to talk to your tax professional, to talk to an accountant, to talk to an attorney, and those disclaimers are very important. But the whole point of this podcast is to make things accessible to every level of real estate investors. So with this topic specifically, understanding the distinction between return of capital and the return on capital does not require an accounting degree, but it does require asking the right questions. And if you're afraid or nervous or are apprehensive to ask your GP questions, there's probably some underlying issues there
reason why.
Yeah, there's probably a reason why outside of this distinction. So
that they should welcome this set of questions, really.
Yeah. And the best operators proactively tell you where your money is coming from, and the ones that don't are worth scrutinizing over a little bit more closely.
Well said.
So yeah, I mean, knowing the difference between the return of capital and the return on capital makes you not just more informed, but also can give you more confidence as an investor. And it gives you the vocabulary to have a much better conversation with any operators that you're evaluating.
Yep, I agree. Well done.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.